We're joined by Bloomberg View columnist and former Pimm CEO Mohamed El-Erian. Mohamed, thanks for joining us. First off, your take on this jobs report.
Well, as you said, it's a very strong job report. Lots of jobs being created, a higher participation rate, and less sluggish wage growth, all of which speaks to a more inclusive recovery.
What do you think about the wage growth specifically? This is what everyone had been talking about so much coming into this report, really, and last month as well. 2.2% year over year, the best that we've seen month over month in 6 years. Is it good? You said less sluggish.
Yeah, it's better. We need a few months of this. You know, it's been the big puzzle. Some of us, including me, have believed that it's just a matter of time before wages respond to what has been strong job creation, and we now know that 3.1 million jobs were created last year. Others were questioning whether this will happen due to structural issues. So it's a good month, but we need to see it sustained going forward.
Mohamed, it's Pimm. Can the U.S. economy pull the rest of the world out of the economic doldrums?
No, the U.S. economy cannot by itself pull everybody else up. What this report speaks to, Pimm, is the theme of divergence, something that I've been stressing. In particular, divergence in economic performance between the U.S. on the one hand and Europe and Japan. And secondly, divergence in monetary policy. This is a report that would encourage the Fed to tweak its patient language in March with a view to starting a very gradual interest rate hiking cycle this summer.
Mohamed, it's Olivia here. Do you think that today's jobs report changes Janet Yellen's timing for liftoff?
It certainly will encourage her because it speaks to more inclusive growth, and I think it will encourage them to start moving on rates during the summer.
Yeah, I mean, previously consensus was for later in the year, or had been continually moving back towards the back end of 2015. Let me play a soundbite from Jim Bullard. Surely you heard it, but I want to get your reaction.
Zero interest rates is not the right interest rate for this economy. We are much closer to goals than we've been in a long time. Inflation is a little bit low, but it's not low enough to rationalize the zero interest rate policy.
Do you agree, and where do you think we should be by, well, where should we be now and where should we be by the end of the year?
Yeah, what Jim Bullard said is what also other federal officials have been stressing lately, including Stan Fischer in December. They worry that the market is getting used to the concept that 0% is normal. Zero is not normal. Zero encourages excessive risk-taking, and they want to start normalizing interest rates very slowly, but that's what I want to do. So I think that what you'll see is that they will get more comfortable with the notion of starting to change their forward guidance language in March. And I think the market is going to respond. And you see this happening today in the yield curve. The market is starting to realize that we may get earlier hikes than expected before this report was released.
The risk, obviously, to I guess a better U.S. economy is what's going on overseas, right? I mean, Pimm asked if the U.S. could pull the rest of the world out of the doldrums. Is it possible that Europe, Greece, Russia pulls us down?
It is possible, and that's why the Fed unusually pointed to international developments as a major risk going forward. And that is something to keep an eye on. It's not just that Europe is struggling, but as you pointed out, there are geopolitical shocks. There are also political tensions between Greece and Germany. We saw that yesterday. So there's a lot going on. Keep an eye on the interest rate differential. Keep an eye on the currency moves. That's going to give you a lot of information as to whether we can have orderly divergence or whether it becomes disorderly.
All right, Mohamed, thanks very much. Bloomberg View column, Mohamed El-Erian joining us on the phone.